Hello and welcome into the KE Report. I'm your host, Shad Markowitz, and I'm speaking today with Jordan Roy-Byrne, editor and publisher of The Daily Gold. We'll put a link to The Daily Gold down below so you can follow along with Jordan's work. And Jordan, I was looking over some of your recent emails to subscribers, and you mentioned one of the factors to watch in the precious metals market is the steepening of the yield curve. Now, we've gone all through this year and last year with different pundits looking at the Fed rate hiking cycle, what it's going to do to the rest of the markets. But when you look at the bond market and what's happened with the short-term yield versus the longer duration yields, it's been inverted for quite some time. What would the steepening of the yield curve mean, and what happens if that trend reverses?
Well, the steepening of the yield curve, if you get it steepening, which in other words, if you're looking at a chart, it means it's rising. So it steepens, it hits zero, and it goes above zero. That's usually a signal for a recession. And all these things are related, basically, because I've talked a lot about how precious metals, to begin a real new bull market, a real new secular bull market, you need a recession in the U.S., which obviously coincides with a bear market in the S&P 500, another leg down. You'd see the stock market probably break below its 40-month moving average convincingly, which is my trigger historically for a new secular bear market. So these things are all related. And so what will precede those things is the yield curve steepening, or at least beginning to steepen. So obviously the yield curve is deeply inverted right now. And if it steepens, basically what that means in the most usual form that's going to happen in is you'll have the 2-year yield, or the 3-month yield, you'll have these things plunging faster than the 10-year yield, which is usually what people use in those curves. And so that's usually a signal that people are getting, or the market's getting really worried that a recession is coming. Now, obviously, if we're looking at bond yields have been moving up, the stock market's recovered, the move is gaining some traction. A recession does not look imminent right now. And so the yield curve has been inverting again. It's been going in the other direction. And so, that's why gold's correcting. Precious metals are really weak right now. The juniors are doing nothing. And so that's really the key. Now, you could get a steepening if you get long-term yields like really blowing out to the upside. So in a super inflationary period, you can get a steepening that way. However, in most cases, it's most likely to happen where you get, the short-term yields are plunging faster than long-term yields.
Well, Jordan, when you think about this yield curve inversion and whether it's steepening or getting less steep, it seems like, as you mentioned, a lot of it revolves around, are we heading towards an imminent recession, or is there a recession on the horizon but being pushed out? We've had so many calls for the recession to have already started earlier this year or by the summer, and it seems like those calls are getting pushed out. Do you think that we will eventually see other economic data that needs to be paired with this yield curve to really trip the trigger and get a correction going in the general markets that would allow the precious metals to diverge from the general markets?
Yeah, I think it's a combination of a couple things. In looking historically, the Fed's last hike, it doesn't always happen, but the market should peak around the time of the Fed's last hike. And then when the market is, the yield curve steepening, usually that coincides with the market rolling over. So the stock market is also an important indicator. So that's really the very first thing to look for is when does the Fed stop hiking? So you have that's going to bring us closer. And then obviously there's the issue of the pause. And obviously a shorter pause is much more bullish for precious metals than if they're going to pause for like a year. That would not be a good thing for precious metals, because that would tell you that the economy is holding up okay and the Fed doesn't have to ease yet. So the first thing to look for is the Fed stops hiking. And then at that point, I think the economic data, it's really important, but the bond market and the stock market are probably going to move, I would think, before, certain economic data comes in. Like you can see the S&P, maybe it corrects a little bit. You see the 2-year yield is starting to come down, and maybe just a little bit. And then you might get some bad economic data that accelerates the process. where you see more of a decline in the 2-year yield and the market rolls over more. So something like that could happen. So that, I mean, those are the types of things, or just at least a scenario that you could look for. Now, the market discounts things in advance. It doesn't know exactly, which data is coming. But I guess what I'm saying is I think the market will show some weakness and bonds should show some strength, yields coming down. I mean, that could probably sense if you're going to get some negative economic data.
Well, Jordan, the other thing we're hearing, though, is more people coming out of the woodwork on financial media and suggesting that we may not have a recession. They're going back to the soft landing narrative, but they're also suggesting that the economic data is going to allow the Fed to pause for a long time. And if that's the case, and the Fed is messaging, hey, we're not going to even cut maybe until next year, they're definitely not going to cut this year. If that's their messaging, that doesn't mean that's what they will stick to. But I would love to contrast that view that the markets have with the research that you've done, showing that after the central banks typically stop hiking, it's not a very long period before they start cutting again. And when they stop hiking, they always think they're going to be able to keep things higher for longer.
Yeah, I mean, it's actually interesting because in an inflationary, if you look at the inflationary periods, the time between them moving from hikes to cuts, there's many examples where it was only a month or two, which is really surprising if you think about it. But the reason is because inflation is such a concern that they have to hike consistently to try and get the inflation down. But once a recession hits, inflation really plummets, and then they have to cut rates. So I think that explains why in an inflationary period, you can get the boomerang so quickly, I would say, where they go from hikes to cuts. But yeah, I mean, I don't really worry that much about Fed statements. I mean, it all comes back to the market. I mean, the market discounts things day to day. The market will discount, economic news, where it thinks the economy is going. So to me, those things are more important than Fed statements. The stock market and the bond market, those are going to be the leading indicators here.
Well, and just as we wrap up, Jordan, when we think about where gold is positioned, where silver is positioned, where the mining stocks are positioned today, it's still not at a terrible place to be, but the sentiment is definitely on the sluggish side to sour side in the sector. There's people that don't want to step in and hit the buy button on the junior mining equities, and the metals prices are drifting slightly lower, but they're still holding their own. Are there any technical levels you're watching, or is there any signs that you're looking for before you would get a little more bullish on hitting the buy button again?
Yeah, I think for gold, there's quite a bit of long-term support in the 1840, 1850 area. There's a lot of moving averages that are all in the same spot. So I think gold, there's a good chance gold comes down to those levels. I'm a little concerned here about the end of the month, end of the quarter. I fear that bears could try a sneak attack here to get gold below 1900. You're right about sentiment. Sentiment is definitely much worse than the price action in the sector. I think it's a lot of investor fatigue. With respect to buying, I would focus on a company by company basis. Err on the side of quality right now. And, when those high quality things get really oversold, they get down to support, buy those. And, later on when we get a bull market, then you can put money in things that are riskier. For now, I'd focus on individual companies and not the sector as a whole.
Okay, some good thoughts for investors to consider as they mull things over in this slower period of time for the sector and pick their spots of where they'd like to either pick up the metals or the mining stocks. Jordan, it's always great having you on the show just to get your insights on how you're looking at the macro setup. Today, discussing the yield curve is an interesting topic. And if people want to get more of the work that Jordan puts out, definitely click on the link below. It takes you over to the Daily Gold. And Jordan, looking forward to our next conversation.
Me too. Thanks so much for having me.